Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 16th of July. I'm Daniel Lam, your host for the podcast. Currently, I'm in Tokyo, competing in the Japan Chess Classic International Open Tournament. This is a key warm-up event for me, leading up to the Chess Olympiad in Budapest in September this year. Now on the ground, I can feel Tokyo's vibrancy, and it reflects the most recent economic data, which paints a cautiously optimistic picture. For example, both the current and outlook components of Japan's Economy Watchers survey rose above expectations in the month of June, following 3 months of decline. Now, in terms of wage growth, it was a glass half full situation. It was below expectations in May, expanding by 1.9% year over year versus consensus estimates calling for a 2.1% year over year increase. This, however, does mark an acceleration from April's 1.6% year over year figure, even though that was revised down from 2.1%. However, some of the report's details suggest that the headline figure understates the strength of pay growth. The 2.5% year-over-year increase in base pay was the fastest growth since 1993. Similarly, base pay amongst full-time workers accelerated to 2.7% from 2.1% year-over-year. Large Japanese companies agreed to hike wages of full-time workers by 5.3% for 2024 during the spring Shunto negotiations. That's the biggest pay rise in 33 years. So this suggests that there's also room for smaller companies to raise wage growth going forward. So if all these were realized, improving domestic economic momentum would give tailwind for Japanese wage growth and allow the Bank of Japan to move further towards normalizing policies. So therefore, we continue to like Japanese banks because we believe the yield curve is going to steepen further in anticipation of potential BOJ tightening, and that helps improve profitability for the banks. The risk there is, of course, the currency. We've seen the sharp down move in the DXY, the US dollar index, after the announcement of the soft US CPI figure last week. Now, any further weakness in the dollar or strengthening in the yen is going to lead to pullback in Japan equities in general. However, we do believe the fundamentals remain fine for Japanese equities overall, helped by continued improvement in corporate governance and a strong underlying economy. So as such, these pullbacks can create opportunities for investors there. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.